Okay, good morning, everybody, and welcome into our presentation. I apologize, we've been having some fun technical challenges here in the Wi-Fi land and Zoom land of COVID time. So really appreciate your patience. We're starting a couple minutes late here, so we'll be continuing for an hour and going a couple minutes late. If you missed the back end of the presentation, then don't worry about it. We'll be also it's been recorded, and we'll be sending out a invitation which will have a link to that recording at the end of the program. So we should be good to go there, and you'll be able to listen to the latter part of the presentation as you need to. So we are going to be talking today about a really interesting topic, namely how to capitalize your co-op. And capitalizing, of course, means that the idea of getting financing into the co-op and making sure that you have a sufficient amount of information that will allow you to get the kind of capitalization that your co-op needs. We're going to be exploring a variety of different strategies associated with that. And then we also will be giving some information about kind of how to find those sources as well. So we'll be talking about all of those things in this presentation. You've received already the materials from today. Those were included in the um, in the email and CLE sign-in sheet that was sent out in the reminder email yesterday. So you can use those to follow along. As those of you who've participated in this kind of presentation before know, we focus it on more of a discussion topic in which we are going to be asking questions of Dave Swanson, who I'll be introducing in a moment here, and getting some information and background from him directly and focusing on that rather than having a bunch of slides with a whole ton of information on them. As we do that, please don't hesitate to ask questions if you have them. We have a series of chat panes that are on your screen. I'll be monitoring those chat panes, so please don't hesitate to ask any questions that you might have about that. Then what I will do is I'll weave those questions into other topics or questions that we might already be asking, or I may ask it directly of Dave as we're going through the presentation. If you'd like to have the question be confidential, just mark it in some way as confidential, and then I'll make sure not to mention your name. Otherwise, I might mention the name of various folks that are listening in. If I happen to know you in particular, then I might use your name, first names only, but in any event. So the topic today is one that's particularly interesting. Dave, just making sure that you're on the line.
I am here. Hello, everybody.
Fantastic. We had, as I mentioned in the very beginning, a little bit of technical challenges with Wi-Fi and the like, but this is terrific. So I'm particularly excited to talk today with you, Dave, because Dave, as many of you know, is the co-chair of our Cooperatives practice group. Is personally, for me, a mentor of mine and someone I call regularly to bounce ideas off of and try and figure out, okay, so we have this co-op, what are we trying to do, and get money into them. And it was interesting, Dave, as we were kind of planning for the presentation and saw the sign-in sheet, it seemed like there were a couple of kind of types of folks that are listening in. We have quite a few bankers, which is great, and people in the financing industry. We also have some really large cooperatives, in particular in the agriculture industry. And then also matched with small ones or even startups in some cases where there is a natural food store or the like that's looking to get money to get their operations going. And so we'll be talking about the strategies that each of those kinds of groups might have and the way that each strategy might apply for kind of various constituents in the cooperative movement. Dave, did you have any kind of reactions to the groups of people and the that are logging in as well?
Absolutely. I went through the list. I have many friends on the list, and hello to all of you. And it is a broad range of types and sizes and age of co-ops. and we'll try to cover information that's relevant to all of you.
You know, it was fun, Dave, attending one time a conference with you, and I felt like I was with a visiting dignitary. So many people say, "Hey, Dave, welcome, good to see you again. Haven't seen you in a year," that kind of thing. And I know we're all really looking forward to being back in a world where we can see one another in person for sure. So today's topic was interesting, and I always start these programs with why pick this topic, why pick it now, and the like. And we're obviously in the middle of COVID land right now, and I was curious, Dave, the topic of capitalization and getting, kind of financing into co-ops. Is that a new thing related to COVID, or is this something that's been going on for a while?
Well, I would say that this has been going on for a long time. In fact, getting equity capital for a co-op is, in many respects, a lot more challenging or limiting than it is for a private equity firm or a pure investment company. And so I don't know that there's any more stress in the system now than there was prior to COVID.
Yeah, it's fascinating when you think about whether you're in whatever chain. The agriculture, for example, was really hit hard by trade wars and the like, and shifts in demand as well. In COVID time, I've definitely had clients where the shift away from food service and other kind of institutional purchasers of food has really dramatically shifted their markets for certain kinds of food-related companies, and then also in the natural food co-ops as well, which we represent many of, and several are here with us on the program today. You've had a real shift in where the demand's happening, and also to some degree your labor force, because now, whereas before you'd have the customers really are almost part of your labor, in that they're the ones who go and do the picking for you for the
Yeah.
food store and take it to the register. And if that's something that customers are demanding now, that really shifts things around a lot. So have you seen any kind of significant trends over the last, say, 3 or 4 years in the area of agriculture or cooperative type financing?
Well, for sure. The one thing is, co-ops are, like you were saying, Mike, there's all different age and size of co-op, and the financing is very different depending on which sector you're in. But in the mature sector, where co-ops, the larger ones, are accessing capital markets and all different financing sources, I would say right now, financing is very low priced, and there are a lot of opportunities. It's a little more challenging if you're a startup.
So a mixed news, I guess. Good news if you're large, established, and have the kind of history of profitability or pre-patronage margin. But
Absolutely.
if you're smaller or growing, it's going to be tough. Well, today's program, we have some goals, and those are the objectives here, is to talk about what does equity capital raising mean, and what are the options that are available to co-ops. As Dave mentioned briefly, that is there are unique opportunities and challenges, I suppose, in the co-op world based on the structure itself. And and in the context of that, to really look at the tax and securities law aspects. I think in particular on the securities side, a lot of co-ops I talk to are surprised that certain things that they want to do are covered by state or federal securities laws. And so we'll talk about that. We're going to list out some options that co-ops have, and particularly the ones that are more popular now, and identify some of the pros and cons of each of those. And then one of my favorite parts of talking to Dave is to get a lot of examples about what people have done that worked really well, and frankly, also what people have tried to do that didn't work as well, and the mistakes to be avoided. So, the first, thing that I think I'm always fascinated by, I have this kind of description of co-ops that, in the normal course with many companies, you have the owners and shareholders. And the shareholders in most companies are looking for a financial return on their investment. And so they, example I use is if you had a share in Apple Inc. And for whatever reason in your area, the device that was going to work better for you was some other device like Samsung or the like, then you really wouldn't spend a minute thinking about whether you should get the Samsung that works better or stick with the one that you're a part owner in. But with co-ops, it really folds that in half. And the definition, of course, of a co-op is that it's owned by the people who use the services or products of that entity. And so that means, in using my example, that there is a different relationship between the members and who have a financial stake in the products or services, and also the of it that are kind of different, I think, from many other companies. So can you talk briefly, Dave, about why that has impact on equity options?
Absolutely. Yep, absolutely. So I'm going to put it this way, Mike. I areas where co-ops are, quote, different than other kinds of companies. And for most of the things that a co-op does, when it comes to legal and regulatory, the fact that you're a co-op really makes very little. When it comes to ownership, governance, and mission, a co-op is very different than a for-profit company that sole or primary motive is to make an investment return for owners. And one of those things is ownership. Ownership is by users or suppliers. One is governance. Decision-making is almost always very broad-based, and it's made by people who have a stake in the organization. It is not the same, or not only motivated by return on investment. It's motivated by getting good supply or good service. And the other thing is mission. And most of the comments I'm going to make today are going to focus on ownership and mission rather than governance. Co-op is, as I've said, not simply to make an investment return for the owners, but to provide service and community of interest for the owners. And that makes a big difference in how decisions are made.
And it strikes me, Dave, that is a double-edged sword. On the one hand, there's obviously some limitations on, the profitability motive and the like. But conversely, it also opens up possibly different channels of investor who are more mission-driven based on whatever the mission of the co-op is.
Absolutely.
And to some degree, with significant capital comes a desire to control how it's used a little bit. And so we'll be talking about governance, I think, too, in the context of that, right?
And that's certainly true in the case of a co-op.
So we've got groups of people who are listening in from various different types of industries, but many are logging in from the agriculture industry. And can you talk about what makes agricultural co-ops different from other kinds of cooperatives?
Sure. Well, I would say that agriculture co-ops have, let me answer this question this way, Mike. There are three areas where co-ops thrived and have thrived for many decades. And all of them have some connection to agriculture. The first is, agriculture co-ops themselves. And the primary uniqueness of an agriculture co-op is that they have a special rule, federal rule that you all know about, Capper-Volstead, which allows farmers basically to collaborate together to fix prices. And Capper-Volstead is one element of agriculture co-ops that doesn't apply to other types of co-ops. Agriculture co-ops were, my view is the development of agriculture co-ops was spearheaded very heavily by the Capper-Volstead exemption, which is a federal policy. The second area is the farm credit system, and the farm credit system was also driven by a federal policy to try and get development in rural areas. And that happened about the same time or shortly after Capper-Volstead in the early 1900s. And I know there's a lot of people from several of the farm credit banks on this call, but the farm credit banks were started and thrived largely because of the capital that came from a federal program, at least initially. And the third area is the rural electric co-ops. And the rural electric co-op, that was another federal program that happened in the 30s. And it was, provided capital and capital raising assistance for co-ops of people who lived in rural America and needed to get electricity. And they couldn't get it from investor-owned companies because the investor-owned companies were focused on making a profit. And there would be, maybe 1,000 customers on a mile of line in the city, and maybe 2 or 3 or 4 in the rural areas.
Or even one.
And that was, or even one, that's right. So it's a lot of the development of co-ops in the rural areas, agriculture, electric, and finance was really a result of federal policies, 70, 80 years ago.
Which to some degree still exists today, as the
Absolutely,
example of the farm credit system just demonstrates. A couple of kind of questions about this for those who are not really embedded in what Capper-Volstead means. That is an exemption that allows a group of farmers, producers, to band together to help support pricing and increase pricing of their commodity in their market, which otherwise might be a violation of the Sherman Act. But with Capper-Volstead, if all of the members are producers, and they're exempt from that. And does that mean, Dave, that if an agriculture co-op allows non-producers in as members, that they could get in trouble?
So in agriculture, good question. An agriculture co-op can certainly have non-producer members, but it can, or participants, but it cannot have non-producer voting members. And that's just one of the rules of Capper-Volstead. Capper-Volstead's main rules are it has to be owned and controlled by farmers or producers. And secondly, that you either have to have an 8% dividend limit on your capital, and that's investment return dividend, or a one member, one vote voting system.
And so does that mean that for agriculture co-ops, they can't take outside money, or just that it's more complicated?
Agriculture co-ops can certainly take outside money, and they do. And, the farm credit bank system is one of the sources of that. So are the commercial banks. But that's debt, not equity. So if you're talking about equity, then there is a limit on, equity is full participation equity means that you, as an owner, own a percentage of all of the economic attributes of an organization or of a co-op. That needs to be limited to the members and users in order to have the Capper-Volstead exemption, and the same is true in order to be able to utilize the tax benefits of being a co-op, primarily subchapter T.
So we'll be getting to that in a moment. And I think the kind of key takeaway here is that if you're an agricultural cooperative, there are some implications of that are beneficial. In other words, that you have this exemption under Capper-Volstead as long as you're careful about it. And then secondly, that it does have some impacts on where and how you get capitalization or investment that may not be true for non-agricultural co-ops. Is that a fair summary,
Yeah.
Dave?
Yeah. Yes, absolutely.
All right, terrific. So we're going to kind of walk through a couple of slides here on the options. And for the people who are listening in, take good notes, because these are summaries of the types of options that co-ops explore. And we're going to be talking about kind of what they are, the implications of them, the tax consequences, the securities law consequences, and the like, and doing it with the slide as a summary of the options, almost like a checklist of sorts. So the first one is member shares. And Dave, can you talk about how members come in and what they are asked to contribute as part of the equity process?
Yeah, certainly, Mike. Thank you. I'm going to group together the first 3 bullet points on this slide. Member shares, patronage, equity retained in a member's name, and non-patronage income allocated to retained earnings. And all of those are solid equity on a co-op's balance sheet. But none of them provide pure investment return. The return is based to the member, is based on participation and not, a percentage ownership or fixed percentage ownership. So member shares, typically it's a pretty low amount to become a member of a co-op. It varies a lot. It's clearly capital on the balance sheet, and I think everyone would view it as equity. Patronage equity is, I would say, certainly in the rural areas with agriculture and electric and farm credit, are probably the primary source of equity on the balance sheet, and it's equity that is, well, in the co-op model, and part of this is based on tax. The tax neutrality that a co-op has. When equity or when profits are made in a co-op, the profits are allocated to the members based on their usage. And part of it for most co-ops has to be paid in cash, 20%, in order to be tax neutral. For some co-ops, that's not the case. And that retained equity is in a member's name and equity in the capital section of the balance sheet. And then
so before we move on to non-patronage, I had a couple of questions, Dave, about kind of starting with member shares. So is it, if you're looking to kind of get money from members directly and they want to participate in the co-op, making sure that we're kind of all talking about the same terminology, you would have basically a membership fee, right? So could be for a food co-op, $5, $10. For a larger agriculture, it could be $30,000, right?
Absolutely, yeah.
And are there ever situations where there's a kind of a capital call of members of a co-op?
Well, wow. So I would say most of the time, no. And this, again, it varies tremendously, but most co-ops, a member puts in the fixed amount of capital cash that they're, required to put in, and leaves, their share of the earnings in their name and as patronage equity. And they also own a portion of the non-allocated retained earnings. But the way or how you define the ownership of that retained earnings varies tremendously depending on the bylaws and articles of the co-op. and it's not money that a member owner has most of the time or almost always a right to call back. But bottom line is a member contributes capital through use and through whatever upfront fee is required, but most co-ops do not have a right to make a capital call. Although many co-ops do have, and this is an article bylaw thing, an ability to offset, if there's losses, offset a member's named patronage equity with a portion of those losses.
So some kind of questions then. We often are working with startup co-ops, either whether it's food or retail, possibly agriculture, and they're trying to kind of get money to get off the ground, which often will be a membership drive, essentially, right? So are there securities law implications of offering membership or membership shares?
Well, yes, but for the most part, there are solid securities, not maybe 100% across the board in every state, but you have two sets of rules: federal rules, SEC, and every state has a system of securities regulation. They're similar from state to state, but they're not all the same. There's a lot of variation. And if you are, for example, a natural foods co-op, raising money from a pool of potential or members in a community, you don't, if you're only offering that share to a resident of a single state, then the federal rules don't apply. And this is basically called the federal intrastate securities exemption. Most states have an exemption that's similar for co-op and for any sale of securities. They're all over the map, but for many states, any sale of a security, preferred stock or whatever it is, to a member of the co-op. Some states do not have special exemptions for co-ops. In almost every state, in fact, in my view, pretty much it's a rule of law that if all you're buying is a membership share, whether you call it a share or just a membership interest, for a relatively small amount of money, maybe $100 or $200 or whatever, that's not a security. And that's not a security because in order to have a security that triggers all the regulatory requirements, there has to be investment intent. And when you're buying a share in a natural foods co-op or a membership interest in a agriculture supply or marketing co-op, it's not really investment intent.
So I think there are two takeaways from my perspective. One is that you want to check to see whether there is a securities issue in how you're issuing the member shares. And then the second is you want to be thoughtful about border towns, somewhere it's on. It could be real easy to have, across interstate lines and without really thinking about it. And so just being aware, I think, is more important. And then, I hear a lot about member loans. And do the same kind of topics apply to member loans as well?
So I've heard a lot of people say that a member loan is not a security. But I think a member loan is clearly a security. It maybe has exemptions from securities regulatory or registration requirements. But a note that says I'm giving you this money and you'll pay it back at some date, or preferred stock that says I'm giving you this money and you'll pay a dividend and may or may not ever redeem it until liquidation. That's pretty clearly a security just about under anybody's definition. But a lot of states, again, have exemptions that allow special rules for co-ops making offering those kinds of securities, preferred stock and subordinated debt.
And then on your balance sheet, I would assume that that's going to be considered a debt, right? It's not an equity investment, even if it's coming from a member.
So there's two ways of looking at this, accounting and tax. And from an accounting standpoint, preferred stock is clearly equity. From a tax standpoint, preferred stock is clearly equity. From an accounting standpoint, subordinated debt, and it just depends on the terms of the subordinated debt. But subordinated debt is going to be classified as debt on a balance sheet, and it's going to be treated as debt for tax purposes. You know, you get to deduct your interest on subordinated debt. You don't get to deduct for tax your dividend on preferred stock. Lenders tend to, and people who are looking at your balance sheet for strength, tend to look at preferred stock as having more equity characteristics than subordinated debt. And subordinated debt, it just depends on, you know, the terms of it. You know, a 5-year subordinated loan is going to get a lot less equity credit when you're talking to lenders than 30-year or 40 or 50-year subordinated loans. So I guess the answer to that question, Mike, is there's 3 ways of looking at it. You know, what are the lenders going to think? What's the tax aspect, and what are the securities or the accounting aspects of it, balance sheet aspects.
And it strikes me, Dave, that that's probably the order that you'd want to think it through, because if what you're trying to do is increase your equity capital, then you really need to think about, okay, what other ways could I get money? And obviously your lenders is a super critical element, and how they're going to view that particular, whatever it is that you're doing is going to be really important in what you decide to do, right?
Yeah. Absolutely.
Almost more than the tax or the accounting basis questions.
Accounting and securities are all important, but if you're trying to raise money, it has to be attractive to the people who are going to put the money in. And one of the unique things about co-op equity raising, just take the natural foods co-ops as an example. Many of them around the country, many dozens, have successfully raised money from their community, not because the people who are, the members who are putting money in are trying to establish an investment fund or an IRA or something that they're going to retire on, and that's an important part of it for them. But what really drives it is the mission. They want to have a locally owned community food store.
Yeah, you started really the presentation by talking about that there are aspects of ownership and return, aspects of governance, and then the mission. And if you're looking at where the sources are, then the mission can make a difference. And have you seen that also play out in other kinds of co-ops like agriculture and the like, where people are driven to that because they're driven to the topic and mission of helping the farmers and the like?
Well, sure. I'm going to answer it this way, Mike. The co-ops and their preferred stock, subordinated loan, or member loan fundraising is driven by very clearly by the desire to have a locally owned community grocery store that they have a say in. When it comes to agriculture and electric, it's a little bit different. Agriculture co-ops will raise money from their members, but most of it's through retained, retention of part of the earnings as capital in a member's name. And that is great. It's not real fast. It takes a long while, to build up equity in a balance sheet, retaining earnings in the name of a member. Most of the agriculture co-ops and electric co-ops that have this kind of a system have been around for a long, long time. So they've been able to build up a lot of member equity. But you have to have financing from some source in order to be able to put in capital and build the infrastructure that you need to operate a business. On, what is the best model to capitalize a co-op? If you need a lot of money up front in order to get started, then, the old, let's retain part of the earnings from members in their name, retained patronage or allocated patronage, it's slow. It takes a long time.
So that kind of it leads to a discussion of preferred stock in a way, because I've seen examples of preferred stock in startup situation where somebody comes in and says, okay, we want to get this thing off the ground, but we're going to do it through a preferred stock allocation and from the get-go. And then also you can do offerings of preferred stock as well.
Yes.
So can you kind of walk through a couple of examples of how preferred stock has worked, kind of what that means and what it means even to be a preferred?
Sure. So I'm gonna give 3 examples here. One is I'm gonna mention CHS, which is the largest co-op in the United States. It has been around for at least a century, and it has a preferred stock program, which is a significant part of the equity on its balance sheet. That was really based on selling preferred stock to funds and investors, and it has a dividend that gives a decent return to those investors. It has no voting rights yet in the governance situation and then member capital, and it's permanent on the balance sheet. That actually is, SEC registered, and it's listed on NASDAQ.
So you could go buy a share if you wanted, that kind of thing.
We could buy a share this afternoon, or a lot of shares this afternoon. And that's one end of the spectrum. You have to be pretty big. You have to have a very solid financial metrics in order to be able to access that kind of capital. That's one market for preferred.
And you mentioned that there's a healthy return. Is that kind of a preferred share subject to the 8% cap?
Well, Mike, the answer to that question is sort of complicated. The bottom line is yes, it is. But it's only really subject to the 8% cap because the Minnesota co-op law that CHS is organized under says you can issue preferred shares, but it can't have a dividend in excess of 8%. There's no reason you couldn't have preferred shares for many co-ops with a higher than 8% dividend. But 8% limit, that dividends on preferred was a significant thing, in the early 80s and through the 80s. It's not so significant anymore because, interest rates or rate of return on investment are just a lot less than they were at that time.
And is it a 8% over the life of the share or 8% compounding? How does that 8% work? Well,
I think it's pretty clear that 8% means 8% per year. Although Cooperative said, I don't think there's been a ruling that definitively defines that.
So obviously that kind of option would exist for a really large established co-op with a lot of patronage equity operations and the like. But you said you had a couple of other examples that people have used in the preferred stock world.
So another I'm going to bring up is I'm going to name Organic Valley, which is an agriculture co-op made up of organic growers. And they have a brand. It's been around for, I believe, around 30 or maybe 40 years.
Yeah, quite a long time.
Yeah, a long time. And they have growers that all started in Wisconsin, but now they're spread out all over the U.S. And they do a lot of different things. Dairy is a big part of it, but certainly not the only thing they do. And they have a preferred stock program that is available to anybody. And you could go on their website today, look at their offering materials for preferred stock, and buy preferred stock. They may not be issuing new preferred stock, but a trade. And that is a very, very unique situation because Organic Valley is a 512 cooperative. It's tax exempt. 521, I'm sorry. It's tax exempt under a special rule that's limited to agriculture co-ops and that's owned only by producers, and it really only applies to marketing co-ops. And there was a time when many agriculture co-ops had this 521 tax status. There are very few of them left, but it has a blanket exemption for federal securities laws. And so Organic Valley is a very interesting example of fundraising from outside sources that is available to them because of their unique status and not to most co-ops.
And then what's the third example?
Well, the third example is, we've already talked about it, and that's the natural foods co-ops and community co-ops that have raised money to, let's just say, build a store or add on to a store. And they tap their members for preferred stock it does not affect their status as a subchapter T co-op. There are exemptions in most states, not all of them, but most states, that allow a co-op to sell preferred stock to its members. And it's usually limited to its members, but not always, without any registration. So that is a kind of a unique market, very, very different than the capital market. Pricing is, for preferred stock with a natural foods co-op, the dividend rate may be fixed, or it may be something that the board of directors establishes annually based on what the co-op's financial performance allows for a dividend to be paid. And then in some cases, those natural foods co-ops have preferred stock with dividends that, if not paid, because the board has decided we can't afford to do it this year, doesn't accumulate. So it's your dividend is 0 to 4 or 0 to 6 or whatever terms are selected, but only if it's declared for that particular year. It doesn't accumulate.
So you're
obviously very different investors interested in those different types of preferred equity.
Yeah, I mean that's kind of the question I was going to, Dave. That they're so different. You've got three different models. One, publicly traded. Second is available to outsiders, but not necessarily listed on an exchange. And then the third would be insider money and presumably friendly capital, or who are mission driven and the like. And how does a co-op find those sources? What are the strategies that have been successful to find the investor, essentially?
Right, investor. So again, it depends on the co-op sector. There is actually there's a number of examples that I'm aware of and have been involved in where a foundation or some kind of a CDFI or not profit-oriented fund has made investments in co-op based on their mission, the foundation's mission, and the co-op's mission. And so there I know of a number of different situations where foundations or CDFIs have actively look for preferred stock investment in co-ops in a sector because they like the business model.
And what is a CDFI? What does that stand for?
Oh, it's a community development fund. Oh, I think it's called the funding institution. And it's a status that you get under Treasury Department rules.
And then, so you could search for that. In other words, looking at the Treasury Department and people who've been already qualified as a CDFI, essentially, right?
Yes, you certainly could.
And then also, I would add into that list family offices and the like. That we've had some interesting experiences with families who've been successful in a business line or a community and really want to give back to their community through helping fund mission-driven organizations. So,
absolutely, yeah.
It to some degree, I think obviously it varies significantly on the size and of the co-op and how much you're looking to raise and the like, but there is a networking strategy that's really not too different from nonprofits that are looking to have somebody make an investment or make a donation in the nonprofit. And similarly with co-ops, there can be a good strategy to develop interest in people who want to help and also can get some kind of a return on that investment. So it makes
right.
it perhaps more interesting than some other things.
Yeah, absolutely.
And then, you talk about deeply subordinated debt here. Can you talk about what both deeply and subordinated means, or I guess first start subordinated and then what it means to be deeper subordinated?
So I would say I use the term deeply subordinated because if you're going to have any chance of getting subordinated debt given credit as equity from a lender, then there has to be certain terms. And, subordination of debt depends on the contract and what you describe in the terms of the note or the contract. In order for subordinated debt really to get equity credit, if you will.
Consideration by the bank, essentially.
Right. Yeah, that's right. It has to say, and I'm pretty sure this is totally accurate. It has to say that if there's senior debt, that's loans you get for lines of credit or for term loans for building facilities or whatever, and whether it's secured or unsecured, that lender is going to want to make sure that if the subordinated debt comes due, and there's a covenant default or some kind of, default scenario going on, that loan cannot be paid back, and it has to wait until, the board of the co-op doesn't decide. The lenders decide whether it can be repaid.
Well, then that kind of leads me to a question, Dave, of how early in the process do you start reaching out to your lender to find out, what would be the elements of a subordinated debt that they would require to see in order to have it not interfere with your equity balance sheet?
I would say it's pretty, if you're like, let's take the example of a co-op that's building a store, and you're going to get debt and you're going to get member loans. Well, you need to be talking both to the debt and the member loans very closely because they go hand in hand.
And to what extent can the bankers help you find other subordinated debt, the sources of that capital?
Well, Mike, I don't really know. I think, with a commercial banker or a farm credit bank or the National Cooperative Bank, a co-op bank, they might be able to help you find, subordinated, funders of subordinated debt. But that's not their role. Their role is to make sure that they're, higher up than the subordinated debt on the capital stack.
So you'd want to know from them kind of what they'd require so that you're not out of covenant
Absolutely.
with the existing loans, but they're not going to be necessarily a place where you could go to say, hey, do you have any resources or places, you'd need to look to other professionals perhaps, or your own network to find the entities willing to provide that kind of debt. Is that fair?
Yes, absolutely. And,
So
and the
then,
terms are all over the map.
yeah,
Maybe we should move to the next slide, Mike, on
yeah,
the joint venture stuff. That's another way that a co-op can raise equity capital or obtain it.
absolutely. And the first topic there is looking at what are the ways that that co-ops can kind of cooperate, which is of course one of the cooperative principles, to band together essentially, right?
Absolutely. So, I mean, many of the co-ops in our co-op sectors in the U.S. and joint venture is a pretty broad term, but if you're for example, look at the federated co-op systems that we have with electric co-ops and with agriculture co-ops, and the same is true for a lot of the natural foods and other community-owned, consumer co-ops. If you got 30 co-ops, each one is going to have a limited access to what market power in buying supplies or goods that you're reselling, and going to have a limited market power, and have limited access to debt, right? But if you take 30 local electric co-ops and have them form a joint purchasing co-op, that's the generation and transmission co-op system, then that generation co-op has a much different, much broader, if you will, ability to raise capital. And it all depends on what your capital needs are. But
Can you talk about what a hybrid co-op is with full participation equity? What does that mean?
So that is, in the last 10 or 15 years, there's been a lot of interest. It started probably 20 years ago in recognizing the fact that a co-op, because of its nature, doesn't have the same access to equity capital as a corporation that really can raise equity capital from many, many different sources. It was an effort to create a co-op model that allowed you to use the co-op name and be described as a co-op, but with part of the economic, the participation in profits and earnings and equity owned by members on a patronage cooperative basis, and part of it be owned by pure investors who don't have any interest other than investing. Although you could have, members participate in both the traditional co-op equity and the investment part of a co-op. And so that co-op model, there's probably about 12 to 14 states that have adopted a uniform co-op law that allows for the co-op to, allocate or distribute some of its earnings to pure investors and some of its earnings to members based on the traditional, co-op patronage system.
And we both are from states that have one, Limited Cooperative
Washington,
Act, LCA.
Yeah, Minnesota, Wisconsin. The one that really formed the model for the national model law was the Wisconsin co-op statute, Chapter 192 it's called. And this is a model that got an awful lot of attention 15, 20 years ago. My experience is that it has not been utilized very much. And a big part of the reason for that is if you are a co-op that distributes some of your income or earnings based on investment versus patronage, then you're not eligible for the subchapter T cooperative tax advantage. So there's these hybrid co-ops allow for full equity participation, but my experience is very, very few of them actually utilize that.
So,
so the joint venture is different. You know, you can a co-op. Let me give an example. How much longer do we have?
Just
Mike?
about 5 minutes.
All right. So I'll try to make this quick. By the way, I apologize. You might want to ask me a question about co-op structures and co-op legal, regulatory systems, but you don't want me being your technology guy. I could not get on this Zoom thing, and we had a lot of people helping me. In any event, joint ownership. I'm just going to use the example of ethanol. In the late 80s and into the 90s and the early 2000s, ethanol was a big growth industry in rural America. And at the very early stages, pretty much nobody would invest in an equity plant, invest equity in an ethanol plant, because it was very risky and uncertain. But farmers were happy to invest in it because they saw it as to add value to their corn or their soybeans. And there were dozens of plants built with primarily farmer equity or significant amounts of farmer equity. And at the beginning, they started with a pure co-op, and the only people who could own equity share was a farmer who was delivering corn or soybeans. But they there was also other sources of equity that was interested, like the local banker and the local business community, who wanted to see that as a business development in their community. And so one of the things that they did, and this is a model that many co-ops use actually, is formed a joint venture, a pass-through LLC that owned a percentage of the ethanol plant. And they also formed a co-op that owned, the ethanol plant would be owned by a partnership, right? LLC or partnership. Some percentage of the equity would be distributed to the co-op, but in a way that allowed the co-op to take advantage of, in a partnership, there's no tax. And the co-op would be able to take advantage of their co-op exemption to pass those profits to their farmer patronizing members on a tax neutral basis all the way through. And that's a model that is an option. If you need outside equity and you can't raise it from your members, one way to do it is form a joint venture.
And find other interested parties who are interested, who would like to have this leasehold or the tenant improvements, or you have a store that you're interested in, and you're willing to kind of set up a venture with the owner of that location, that kind of thing. Right. So something to the side. So I want to.
It's a good model. It's not perfect because you can have. The people who are putting in the investment dollars might have a very different mission than the people who are patronizing and are members of the co-op. But you can, especially if you can, as a co-op, have a controlling interest in that JV. It's a pretty, it's a potentially good source of equity capital.
So we wanted to end with kind of 5 steps, what I call the top 5 things I could do today that would help improve my company, my co-op, and the like. And we came up with these. Dave, how why were these the top 5 things that you would recommend to somebody?
So I would say that it's easy to talk about the legal aspects of raising capital in a vacuum, or to focus on the legal aspects. But the legal aspect is actually only a small part of it. And what really is important is, how much capital do you need? What kind of balance sheet do you have? What are your goals and needs for capital investment in the future? What is your industry situation? Are you under a lot of competition or less? And, you know, deciding how to raise capital in a co-op starts with what your capital needs are, not with what the options to raise money are. So I would say, you know, be thinking about what, you know, and thinking ahead, you know, what opportunities might we have if we stay with our current system, and what opportunities might we lose if we don't, you know, change as the industry changes and the competition changes.
You know, I was thinking the same thing, that a lot of it is looking forward and saying, okay, what happens if there's demand shift in our market? What happens if there's a fire or a pest that infests in our area? And really kind of having contingency planning around that, so you know what to do in certain kinds of scenarios. You know, with understanding the industry and the competition, that also means, you know, what other investments are your competitors making, and do you need to do those things in order to keep up? So, you know, really having a real executive team, you know, part of your annual strategic planning being, and the balance sheet and the like. And then I would do a shout out to the base capital policy, particularly for larger co-ops. Base capital policy is basically a policy that's set in advance about what you're going to do for your equity allocation, cash versus equity, and also when you're going to be paying back or revolving the equity that someone had put in 5 or 10 years ago, and when you'd be paying that out, or allowing for resignations of membership or retirement from membership, and then really sticking to that. And the sticking to it part is really hard, because, you know, in many co-ops, you operate on your margin, and so if there is a drop in a commodity price, then that drop also decreases the net of your margin. And so that at the same time, of course, your members are clamoring for cash, and so it puts co-ops in a real bind. And my experience has been that really thinking that through in advance is super important, so that you can say, hey, before the fog of war, this is what we decided we were going to do, and with a strong bias in favor of do what you'd planned. Is there anything about what's happening now that forces us to change our strategy? And that can really help you a lot to explain to members why, no, we're going to maintain what we had planned to do, notwithstanding the challenges that are out there in our markets. And then the final point, just a shout out to you, Dave. I've always really appreciated being able to, I left it in there. I was going to put attorneys, but I said, no, just call Dave Swanson. You've been such a tremendous resource to me personally, and also to the many members of many different types of co-ops over your extraordinary career. And I think also really get great partners. The financial partners with banks that specialize in the cooperative market and can kind of understand how it works. And I think that's really important, particularly in commodities or others where knowing the impact of the timing of payments. You know, if you're in a commodity market where you only really are having income in certain parts of the year and you need to be carried for the remainder of the year, is important. Getting good investment bankers, getting good accountants who can help make sure you're maximizing the tax implications, and who also often will have investment banking assistance that's provided through the accounting firm as well. So do you have any final comment, Dave, that you'd recommend folks think about as we wrap up here today?
I just want to say thanks for everyone for participating, and I enjoyed it. Thank you, Mike, and everyone.
All right, terrific. So the final things, this is where, hit the wrong button here. As we're wrapping up, to get credit, again, just complete the sign-in form that you received yesterday as part of your announcement. And we'll be sending you then CLE certification of this program from Michelle Hubble at dorsey.com. She manages our CLE program. So thank you, Michelle. For those who are interested, we've, as you know, prepared a book on cooperative business law, a practical guide to the special laws governing cooperatives. That was just recently updated to the 3rd edition and available through us, or also available through Amazon. Just, we're trying to enter the market here of technology. And then finally, if you have any questions, please don't hesitate to reach out to either of us, in particular Dave, or any other member of or our cooperatives practice or food, beverages, and agribusiness industry group as well. So with that, thank you for joining us. We hope you'll attend other iterations of the Interactive Dialogue series. And then finally, important to end on the note, to all the cooperatives, happy National Co-op Month. We celebrate you, celebrate cooperatives and the great work that you do in each of your communities.